Hello and welcome to today's Cabot Wealth webinar. Boost your profits in all markets with great growth stocks and covered calls. I'm your host, Chris Preston, Chief Analyst of the Cabot Wealth Daily Advisory and Managing Editor here at Cabot Wealth Network. With me today is Jacob Mintz, Chief Analyst of our Cabot Options Trader and Cabot Options Trader Pro advisories, as well as our newest advisory, Cabot Profit Booster. Today, Jacob is here to talk about the strategy behind this new advisory, including how to squeeze even more profits from great growth stocks, what a covered call is, and how to execute this conservative yield-boosting options trading technique. He'll also give you a few actionable covered call trade ideas using stocks selected by our resident growth investing expert, Mike Santolo. This is an interactive webinar, which means we'll be fielding your questions after Jacob's presentation wraps up. So if you have a question, feel free to ask it at any time, and we'll try to get to as many of them as time allows once Jacob wraps up. And just keep in mind that we cannot offer advice in regards to your own personal investing situation or portfolio. First, let me introduce Jacob. Prior to arriving at Cabot, Jacob was a market maker on the floor of the famed Chicago Board of Options Exchange, where he ran several trading crowds for nearly a decade. He then moved on to a top-tier options trading company, where he ran a trading desk that traded against some of the most sophisticated hedge funds and institutions in the world. And today, Jacob trades for himself, coaches and teaches about options trading, and runs our Cabot Options Trader, Cabot Options Trader Pro, and now Cabot Profit Booster advisories, as I mentioned before. Long story short, Jacob knows what he's talking about when it comes to options trading, so I'll let him do just that. Jacob, take it away.
Thank you, Chris, and welcome everybody to Cabot Wealth Network's webinar on how to boost your profits in all markets with great growth stocks and covered calls. As Chris said, my name is Jacob Mintz. I'm the Chief Analyst of Cabot Options Trader and Cabot Options Trader Pro, as well as our newly launched product, Cabot Profit Booster. As Chris mentioned, if you have any questions at all, please submit them via the chat feature. Teaching about options and options trading is truly one of my passions, so if there's anything that I'm saying during this presentation, please send in your questions if you don't understand what I'm talking about. So let's get started. As we all know, it's a pretty strong bull market. The S&P 500 is approximately 1% from all-time highs. So we're going to talk about a couple strategies to make money in a bull market. And those strategies are how to buy calls and how to execute buy rates and cover calls. First, a little bit about me. I graduated from Miami of Ohio in 1999, and I was taking interviews in Chicago at the hot jobs at the time. Those were consulting jobs at Anderson Consulting, PricewaterhouseCoopers. Well, my uncle saw that I really wasn't into those type of jobs and those job interviews, and he let me know that he had a neighbor who was making a lot of money on the Chicago Board of Options Exchange, the CBOE. He introduced me to that trader, and I got the job. And for the next year, I worked with that trader, a trading floor legend, and just learned about what a call is, what a put is, what a buy rate is. Moved on to more advanced strategies. Eventually, they put me on a trading badge, which meant I was a market maker myself. So what does that really mean to be a market maker? Every day, I would go down to the trading crowd and join 50 other guys in that trading crowd making markets. It was my job to provide liquidity to you, the individual investor. So how does that really work? Well, if you wanted to buy Facebook calls, let's say, you would call your broker at Morgan Stanley and say, I want to buy the Facebook January 200 calls. That broker would come into our trading crowd and say, where can I buy the Facebook January 200 calls? Well, it was then my job to provide that liquidity. I would look at my theoreticals and I would say that option is worth $2. And because it's worth $2, I'm willing to buy it for $1.75. I'm willing to sell it for $2.25. Essentially, I have 25 cents of edge, $25 of edge if I bought it or if I sold it. Well, so I would say $1.75 bid at $2.25. The broker would then call you back up and say, you can buy them for $2.25. You say, buy them for $2.25. And he would come into the crowd and say, we'll buy them for $2.25. I would say, sold, sold, sold. And that's how the transaction would happen. Now, that's the type of order that was our bread and butter. Just, trading 1 lot, 2 lots, 5 lots, 10 contracts at a time. Where things got a little bit dicier is when a Goldman Sachs broker would come in the crowd looking to bash me over the head with his order. These were guys who were representing the smartest hedge funds and institutions in the world. And they weren't looking to buy 5 or 10 options. They were looking to buy 1,000, 5,000, 10,000 options, risking millions and millions of dollars. Inevitably, what would happen when they bought all those calls from me, when I'm selling these calls to the smartest hedge funds and institutions, inevitably there would be a takeover or a rumor. At some point after this happened to me over and over again, I became smart enough to realize it was time to start following the smart money. These people weren't risking 10, 20, $30 million based on wild guesses. They were looking to put on these trades because they had insider information. So it became my job to follow into those type of trades. Now, who trades options? The best of the best. Warren Buffett has been known to trade options. Carl Icahn's been known to trade options. George Soros, David Tepper. These are the people who are trading these big option contracts and who we follow into at Cabot Options Trader. So when we're in a bull market and I see big call buying, I want to also buy calls. Now, even though people have been screaming the end is near for quite some time, the bull is still in charge. And so what we do at Cabot Options Trader is buy calls along with these gentlemen. So we're going to get into how to buy a call option, and I'm going to first give a definition, and then from there I'm going to break down what that definition actually means. So a call option gives its holder the right to buy 100 shares of a stock at the strike price anytime prior to these options expiration date. That's just the definition. We're going to break down what that actually means. Each one equity option contract represents 100 shares of the underlying stock. That's a critical component of this whole thing. If you buy one option contract, that gives you the right to buy 100 shares of that underlying stock. It's a multiplier of 100. If you buy two calls, that gives you the right to buy 200 shares of the underlying stock. The next important component is the potential loss for the holder of an option is limited to the initial premium paid for that contract. So the most you could possibly lose when you buy a call is the premium paid. So if I buy a call for $2 or $200, the most I could possibly lose is that $200. While there are some misconceptions in the market that options are risky, in fact, they are a great way to get exposure to stocks at a defined risk. I'm going to show you exactly what I mean by that. But first, let's talk about which call option should you buy. Let's say you like Facebook and you are ready to log into your brokerage platform and buy a call. There's a lot of calls in terms of strike prices and expirations. Well, I'm going to show you which ones I would recommend. Now, first off, at Cabot Options Traders, we're trying to play the right odds. We're not like this gentleman who gave the tip that the best way to increase your chance of winning the lottery is to buy as many tickets as you can afford. That's not the way we do it. We're putting on smart bets where the odds are in our favor. So for example, if Facebook is trading at $199, $200 approximately, I would recommend buying calls near the current stock price. So if the stock's trading at 200, I would recommend buying the 200 strike call or the 205 strike call. That is why, and why do I do that? Because it's likely that Facebook can trade well above 200 or 205. However, I don't recommend buying calls that are very far away from the current stock price, like the Facebook 250 calls, because it's less likely that Facebook will get to 250. For that reason, I recommend buying calls near the current stock price. Next component of choosing an option is time. Time is critical when choosing an option to buy. If Facebook is trading at 200, I don't recommend buying calls that expire this week or next week. Why? Because a tweet, a trade war headline, the Federal Reserve speech could move the market a lot in the very short term. And even though there are call options that expire this week and next week, it's just really hard to time the market on that type of short-term horizon. However, I recommend buying calls with 3 to 9 months until their expiration. Why? Because that tweet that could send the market down 0.5% or 1% could ruin a call buy that is targeting a move next week. But if you give the market and the stock 3 to 9 months, to make that move that you're expecting, there's a greater likelihood of success. So let's take a look at an example using those parameters. Let's take a look at Walt Disney. The stock recently exploded on the release of its Disney Plus subscriber numbers. And so if we wanted to put on a bullish trade in Disney, and if there was big hedge fund and institutional call buying, I might look to do the following trade. I might look to buy the Disney April 150 call for $7. So why am I choosing the April 150 call? Well, like I talked about earlier, I'm looking to buy a call with somewhere between 3 and 9 months until its expiration. In this case, if I bought these Disney April 150 calls, that's giving me approximately 4 to 5 months of time before these calls expire. The strike price is 150. Now, when I put together this slide, Disney was trading at about 147.5. So again, I'm buying calls that are pretty close to the current stock price, and that's why I chose the April 150 call. Now, the price is the next important component. When we buy an option for $7, that's actually $700 because it's a multiplier of 100. So if we buy that call for $7 or $700, the most we can possibly lose on this trade is that $700. The risk in buying these calls, like I just said, the potential loss for the holder of an option is limited to the initial premium paid for the contract. So in this case, the most we could possibly lose is that $700 per call purchase. So let's take a look at the profit and loss graph for this trade. Again, we bought the Disney April 150 call for $7. If Disney were to fall on earnings, or if these original Disney Plus numbers start to slide, and the stock drops to 130 or 135, the most we can possibly lose is $700. However, to the upside, we have unlimited upside exposure. So if these Disney Plus numbers continue to really grow and the stock is taking off, if we buy that April 150 call and the stock's trading at 180, we have the right to exercise the right to buy Disney at 150. Power of options. Instead of paying $14,700 to buy 100 shares of Disney, you could pay $700 for the opportunity to buy 100 shares at 150. That's really the power of options. We're paying $700 to have exposure to Disney versus if you had to pay $14,700 to buy 100 shares. And you can see it's been a great little run for Cabot Options Trader. In 2018, when the market was essentially unchanged, we absolutely killed it. And we did this simply by following the big hedge fund and institutional traders into their positions. So why else would you buy calls? A good use of calls is ahead of earnings because there's a big event risk. If a company reports earnings and the stock falls dramatically, you could potentially have a big loss. But with call options, you can mitigate that risk and by having less money at risk. So let's take a look at Oracle, which will report earnings tomorrow night. Stock ran up to about 57 recently, but then started to sell off in the last couple of days. So with Oracle reporting earnings tomorrow, and with the stock trading right at 55, we might look to buy the Oracle January 50 calls for $1.50. Now, I do want to say I'm not necessarily recommending this trade, but just this is a perfect example of why options are powerful. So again, the stock's trading right at 55, so I would buy the 55 strike call. The date of the call's expiration is January 17, 2020. The strike price is 55, and the price we're paying is $1.50, which is actually $150 because it's a multiplier of 100. So when you are executing this trade, the most you could possibly lose is that $150. And here's the profit and loss graph of that trade. If Oracle were to fall dramatically on earnings, let's say to $45, the most you would possibly lose is that $150. However, to the upside, we have unlimited upside exposure. So if somehow Oracle jumped to $63 tomorrow, we would have the right to buy the stock at 55. Power of options. It's really a leverage game. Instead of paying $5,450 to buy 100 shares of Oracle, you could pay $150 for the opportunity to buy 100 shares at 55. This is a risk-defined trade that will take out a lot of that risk that we know that can come during earnings season. Moving on. Now we're going to talk about Cabot Profit Booster, which is our newly launched product just yesterday. As many people know, the Federal Reserve and central bankers across the globe have driven interest rates to near 0%. This has created a real problem for traders and investors looking to create yield in their portfolio. This is a problem. However, at Cabot, we've come up with a solution. We're going to combine the stock picks of Mike Santolo, chief analyst of Cabot Top 10 Trader, with my covered call ideas to make money 3 ways. First, a little bit about Mike. Mike is someone who eats, sleeps, and dreams about stock charts. And what he does at Top 10 Trader is he recommends the 10 stocks that have the best charts, numbers, and stories every Monday evening. Mike's recommendations can make money 2 ways for his subscribers, as these stocks can rise in value, as well as some of the stocks he recommends pay dividends. And the third way Cabot Profit Booster subscribers can profit is to then add one of my covered call ideas, which I learned about as a former market maker on the floor of the CBOE. And we're going to recommend those covered calls on Mike's stock picks. So what is a covered call? First, we're going to give a definition. A covered call consists of buying or owning a stock and selling a call option on that stock. You could sell one call on each 100 shares of stock you own. So if you own 500 shares, you could sell 5 calls. Now, when we were talking about Disney earlier, we were talking about paying a $700 premium. Well, when you sell a call, you actually collect a premium. So if we were to sell that Disney call, we would collect that $700 premium. That would instantly come into our account. So if you sell one call for $1, that's actually $100. Again, it's a multiplier of 100. If you sell one call for $2, you actually collect $200. Why is this such a popular strategy? This is a great way to create yield against stocks you already own. Also, this is a very, very conservative strategy. Selling calls doesn't increase your risk. In fact, it reduces your cost basis on a position. Why would you not sell covered calls? They do limit your upside. You wouldn't want to sell a call on a stock if you think the stock will go up dramatically and want to participate in the stock's rise. So let's take a look at a covered call I executed on Lattice Semiconductor, symbol LSCC, which is a stock that Mike recently recommended to his top 10 subscribers. LSCC, this is now Mike's technical analysis. LSCC had its coming out party in February of this year when it decisively gapped some new multi-year highs, eventually pushing to 15 in early May. The stock then rested for a couple of months, but reached new highs in July and then gapped to new highs after the Q2 report late last month. Impressively, it's held firm since. Suggested loss limit 15.5, 16.2. So what did I do after I saw that top 10 write-up? I bought a LSCC covered call. What did we do? We bought stock at 1938 and we sold the September 20 call for 64 cents. Now remember, when I sell that call for 64 cents, that 64 cents is actually $64 as it's a multiplier of 100. That $64 comes right into my account. Now also on this slide is my static return and covered call return, which we're going to break down in the slides to come. Now let's break down the various scenarios of this trade. I bought stock in 1938 and I sold the call for 64 cents, which reduces my break even on this stock purchase to 1874. Remember, this is a very conservative strategy that reduces my break even on my stock position. So in this case, LSCC could fall as low as 1874 and I wouldn't lose money. Now let's move on to the scenario I refer to as static return. If LSCC doesn't move for the next month, that September 20 call that I sold would expire worthless and I would collect that $64. That's a yield of 3.41% in 1 month's time. We've created a yield essentially against a stock that hasn't moved. Now let's talk about the best case scenario. The best case scenario for this trade is if LSCC rises to 19.99 with it just under the September 20 strike that I sold. In this scenario, I get to keep the stock holding, as well as the stock gains as the stock rose from 1938 to 19.99, as well as the call premium. I've created a yield of 6.67% in 1 month's time. The worst case scenario for a covered call is where the stock drops dramatically. In this scenario, I would lose money on the stock holding, much like if I owned any stock. However, because I collected a call premium, my losses aren't so bad as I lowered my cost basis. Remember, this is a very conservative strategy that it actually reduces your risk. The next scenario is what I refer to as covered call return if assigned. In this scenario, LSCC rises above 20 on September expiration. If this were to happen, the trader who bought the call from me would exercise his right to buy the stock from me, and I would not participate in significant upside should the stock rise dramatically. However, I would have made $62 on the stock rise, as well as $64 from the call sale. And net, I would have a profit of 6.72% in 1 month's time. This would be a great scenario. So how did the trade work out for me? The September 20 call that I sold expired worthless, and I created a yield of 3.41% in September. Then in October, I sold the October 20 call for 80 cents and created a yield of 3.2%. While a yield of 3% in 1 month's time doesn't sound like a home run, in this zero interest rate environment, if I can create yields of 3% to even as high as 15% every single month, these trades do turn into a home run over the course of time. So what do you get at Cabot Profit Booster? Every Monday morning, Mike will release his top 10 stock ideas. Then Jacob will find the stock from that list that has the best covered call potential and send you my trade idea Tuesday morning shortly after the market opens. trade idea that will include a portion of Mike's analysis, as well as his full technical analysis, chart, and his stop, which we will be tied to. We will use Mike's stop as our stop. Then I will break down my trade idea along with the break even, which we discussed earlier, as well as the potential outcomes. And lastly, I will include a breakdown of our current open positions. And most importantly, if you're new to options or to covered calls, if you have any questions at all about the trade idea, our open positions, or if you're new to options and want to discuss with me how to execute a covered call, you have access to my personal email at jacob@cabotwealth.com. And now I'm going to turn it back over to Chris.
Yeah, thanks, Jacob. I'm going to give Jacob a minute to catch his breath before he starts answering some of your questions. And by the way, if you've not sent in questions yet, now is the time to do it. But first, let me tell you how you can sign up for Cabot Profit Booster for those who are intrigued by that. We have a special offer reserved exclusively for listeners of today's webinar. It's half the normal price with a money-back guarantee for your first 30 days. And when you subscribe, as Jacob mentioned, what you get are Jacob's weekly Cabot Profit Booster recommendations featuring stocks with high momentum that were recommended the day before by Mike Santolo in his Cabot Top 10 Trader Growth Stock Advisory. You also get regular updates, real-time trade alerts, access to all of Jacob's past recommendations, and direct email access to Jacob. Sign up now by clicking the link that's on the screen now, cabotwealth.com/CPB special. You'll also, for those who are tuning in today, you'll also receive an email in your inbox tomorrow with the offer. You can just click on that and sign up for it. And again, it's half the normal price with a 30-day money-back guarantee. Now let's get on to your questions. Let's see. First one, Jacob, is the intent of Cabot Profit Booster to collect option premium while price is accumulating? Once it breaks out, thus capping profit by having sold the option. Can you help me understand your rationale for what you're trying to achieve?
Sure. So this is the point of Cabot Profit Booster is to really make, like we said, make money three ways. We're hoping that the stock goes higher, as well as there'll be some dividends that we collect along the way, depending on the stock pick, as well as the covered call return. So if we can create a yield of 10%, 15% in 1 month's time, that is a home run if you do enough of these. And we're going to release 50 trade ideas a year. Now, will we miss out potentially on some 30% winners and 40% winners? Yes. If we're in a wild bull market, then we will be disappointed, and I'm doing air quotes, disappointed, only making 10 or 15% on a trade. That being said, if we're in a choppy market or a down market or a market that's just kind of grinding slowly higher, this is a strategy that will work out big over the course of a year. And in fact, there's been countless studies that, and some that I've written about recently, where over the last 16 or 18 years, a buy rate strategy, buying the S&P 500 and selling calls out of the money, have greatly beaten the S&P 500. So this is just a way to make this is I'll say it's a safe strategy on growth stocks and a way to safely create yields of 3 to 15% on these stocks.
Great. And Jacob, heard you say the word buy right. There's another question asking for clarification on what the difference between a covered call and a buy right is.
So that's actually a great question. They are essentially the exact same thing. They are the same thing. It's essentially like I would say the word chowder, and somebody else would say chowda. They're the exact same thing, just said differently.
Okay. Let's see here. Jacob, you showed your strong performance from 2018 when the market was even or volatile. Does volatility actually help you?
So yes, in general, I'm somebody who thrives on volatility. If the market is getting shook up and if stocks are falling hard, that presents a lot of opportunities for me. Especially now, that works for me for buying calls for sure. When I've been waiting to buy a stock and the stock drops dramatically, that obviously opens up the opportunity to buy a call option cheap. But also in terms of volatility, the higher the volatility in the market, the more expensive an option is, which actually makes selling covered calls against stocks even more profitable, because an option in a low volatility environment might cost $1, but in a high volatility environment, that option may be now worth $1.50 or $2. So we're actually selling more expensive options. So yes, I mean that is my dream scenario. The initial, if the market drops 5%, 10%, out of nowhere, that initial move might be slightly painful, but it really, really opens opportunities for big profit potential going forward.
Okay. Let's see, here's a question, sort of a logistical question. Jacob, how will you choose which of Mike's stocks to recommend the following day?
Yep, that's a good question. So we just released our first stock Cabot Profit Booster stock idea yesterday. And I looked at Mike's list, and what I was really looking for was, number one, liquidity. I need to make sure that the subscribers can get into these trades. So let's start there. That's an important component. The next component is just the premiums that we can achieve. So I recommended a trade yesterday, a covered call in Splunk. The yields, because Splunk is a somewhat volatile stock, that gave me and us the potential to have a return of approximately 6% if the stock didn't move. So the static return that I was referring to earlier, and as high as nearly 10% if the stock went up several dollars, if Mike's bullish thesis played out. So those are really the liquidity is an important component. I'm also going to try and keep the portfolio relatively balanced. I'm not going to push 9 straight semiconductor stocks, let's say. There might be a semiconductor stock one day, the next week it would be a biotech stock company, and the next a financial. That's not my entire focus, but it is one component of how I'm going to select the stock. That's a good question.
Okay, here's a question from Elizabeth. Can you discuss your strategy for buying back the calls? Will you hold them until they expire almost worthless, or will you buy them back for, say, 50% and then sell new calls?
That's a good question. So I don't have necessarily a defined rule on this. One of the most important components of this will be the state of the market at this time. If we're kind of in the ideal volatility selling environment, then I might be looking to handle that trade one way. If we're in a environment where the market is falling apart, I might manage the portfolio a different way. It's really, I am, other than the stop, which we are tied to from Mike, I kind of have a little latitude to be able to manage this the best way possible. And like I said, it'll just depend on how a stock is performing, how the market is performing, how much premium is left in the trade. If we sell an option for $1, like she had said, that option is now worth 50 cents. It kind of just depends on how much time is left until expiration, how the stock looks, its relative performance, as well as the overall market's performance. Again, another good question.
Yeah. See, here's one. Jacob, wait, hold on. One from Jerome. Do you look for a percentage return when to sell the option?
Well, I mean, to be honest, I'm not going to waste our time and selling calls that'll return 1% or 2%. I mean, look, even if you make 1 or 2% on each trade each month, that's a great year, but that's not what we're here to do. We're looking to create yields of, at a minimum, 3%, 4%. That would be the lowest percent yield that I'm looking to create. I'll probably be more looking for stocks and trades that can create yields of between 5 and 15%. That'll be the goal. But that being said, I'm not going to necessarily just force a trade on because it has a high yield potential. I don't want us to lose money chasing these type of yields.
Okay, good to know. Let's see. Jacob, you mentioned rotating between sectors. Is there a particular sector or sectors where your recommendations usually come from?
Well, these are all going to come from Mike's picks. At Cabot Options Trader, we execute some covered call ideas, probably about, I don't know, 5 to 10 a year. Those are based on the unusual call activity that I talked about earlier. So if I see a lot of call buying like recently I saw a lot of call buying in JetBlue for Cabot Options Trader. That drove the price of those options up very aggressively, and we executed a covered call on that. But that is strictly to Cabot Options Trader. At Cabot Profit Booster, these ideas will come exclusively from Mike. So as we know, Mike moves in and out of sectors. He's going where the smart money is going. So if he sees a lot of stock strength in financials, well, then he's probably going to recommend more financials, and I will, also notice that trend and go along with Mike's picks. At Cabot Profit Booster, all the stock ideas are Mike's.
Okay. Here's an interesting, somewhat unrelated, well, no, related question. Jacob, what's your best story from being a market maker at the CBOE?
Well, I've told this story a couple times at the Cabot Wealth Summit. So many years ago when I was a market maker on the CBOE, it was the summertime and there weren't a lot of guys in the trading crowd. And a broker, one of these big brokers, came into my trading crowd and was asking us what the market was on some Google puts. We gave the market and he said sold. So we bought. So there was only a couple of us in the trading crowd. If the normal trading crowd had 50 guys in there, at this time there was only like 3 or 4 of us. So we said sold and we bought some. Let's say we bought them for $10. Well, the next thing we know, he comes in again. He says, where can I sell them again? We say, we'll buy them for $9. He said sold. So we buy some more for $9. So we're dropping the price because we don't want to be buying lots of puts at the exact same price. He comes in again. He says, where can I sell them now? We say $8. So we buy them for $8. Now I'm starting to accumulate a lot of these puts. But because the prices are so good, I'm thinking in my mind, I'm like, well, these are great trades. I originally started buying for $10 and now I'm buying for $8. Next thing you know, he says, where can I sell 10,000 puts? So now I buy a lot of these puts for $7. I'm thinking in my head, I'm like, I'm buying a lot of puts, but these prices are fantastic. Well, this keeps happening and happening. I just keep buying more and more puts. At the end of the day, I go up to the my trading office and I look at my position. I've bought approximately $15 million of Google puts, and I am freaking out. I'm a young trader at that time, and if I lose $15 million, if Google doesn't move for the next couple months, these options keep losing value, I'm going to lose my job. I'm going to lose my dream job because I've bought all these puts. That night, I go home and I'm freaking out to my wife. I don't sleep all night, but I say to myself, look, on the open, I'm going to sell a quarter of this position. I'll take a loss if I have to. I just need to protect my job. Well, the day starts, the market opens. I immediately sell a quarter of my position for, just a small loss. I'm starting to feel a little bit better about it. I could think rationally. Next thing you know, Google drops $10, $20, $30, $50, $80. The stock drops in a blink of an eye. Those brokers are going crazy trying to buy puts from us. Nobody knows what is going on. I immediately sell my entire position for a massive, massive winner. We have no idea what's going on, but I am just getting out of the position for the trade of my career. Next thing you know, stock shoots all the way back to unchanged for the day. So what is the news that we later found out that drove this big price decline? At a Google investor conference, the CFO had put the wrong slide into his presentation, which had the wrong metric on advertising or whatever it was. It didn't even matter. They immediately realized that they had made that mistake and they changed the slide out, and that's when the stock rallied back. And so that was really the greatest trade of my career. It was better to be lucky than be lucky than good scenarios, but that is the story that I will tell my grandkids one day.
But does that story top, this is me asking, does that story top the time that your boss's secretary hit his opponent over the head with was it a printer?
No, that's another story. So, back in the old days of sorts, there were a decent amount of fights in the trading crowd, and my boss was one who would definitely get in quite a bit of fights, and he was a very cheap gentleman, and he was known for never giving a bonus. Well, one day he's in a fight with another guy in the train crowd, and the other gentleman has my boss pinned down, is hitting him in the face over and over again. Well, my boss's clerk at that time is a young lady, probably about 4'5", maybe weighs 75 pounds. She picked up his printer and hit the guy over the head with it and knocked him off my boss. And the fight ended, and my boss walked across the street and took out $10,000 cash and gave his first Christmas bonus that he had given in many years.
It's a good story. Let's unless people have any other questions, not seeing any, let's go ahead and have that be the final word. But Jacob, thanks for that, and thank you all for the questions and for joining us today. We'll be back next month on January 23rd at 2 o'clock Eastern also with another webinar, this time featuring our growth investing expert, Mike Santolo, you've heard about so much today. It's his 2020 investing outlook, which will feature Mike's thoughts on the year ahead, as well as 3 of his best growth stock ideas. So mark that on your calendar. That does it for us, for Jacob Mintz and the entire Cabot Wealth Network team. I'm Chris Preston. See you next time.